Um, if you are a curious learner tuning into this deep dive today, you're, you're probably pretty well aware of the global housing crunch.
Oh, absolutely. It's everywhere.
Right. I mean, it's a story we hear everywhere. Skyrocketing rents, impossible mortgage deposits, and just this general feeling that the traditional housing market is, fundamentally broken for a huge portion of the population.
Yeah, that's exactly the sentiment.
But today we have a stack of source material that outlines an entirely different approach to the problem. We are looking at a design development document detailing a state policy proposal, and it's known as Ireland's Perpetual Bond Model for Sustainable Housing.
And looking strictly at the mechanics and the intended outcomes outlined in the text, I mean, it is a massive departure from how property is traditionally financed and occupied.
Definitely.
We are analyzing a highly regulated state mechanism here, so our goal today is to just understand how a model like this would actually function on paper rather than, endorsing it either way.
Right, exactly. And that is the mission for our deep dive today. We're going to explore this exact proposal. We are looking at a model where the document suggests occupiers get brand new homes, put down zero deposit, hold no mortgage, and pay a rent that is set on day one and never increases.
Yeah.
Ever.
It's quite the claim.
It is. Okay, let's unpack this because I know that sounds like a hypothetical best-case scenario, but the document we are looking at maps out a very specific economic engine designed to make it a reality.
It does, and it relies on some really intricate financial architecture to get there.
Yeah.
The policy intent isn't just about building houses.
Right.
It is about completely restructuring who actually holds the financial risk.
So let's start by putting you right into the shoes of the occupier.
Mm-hmm.
Imagine you are moving into one of these brand new homes. According to the target vision in this document, the average occupier would pay less than 1,100 euros a month.
Which is significant.
Yeah, but the defining feature here is the absolute zero risk of that rent ever increasing. You are theoretically shielded from inflation, shielded from market spikes, and there is no risk of a landlord deciding to sell the property and evicting you, provided you just pay that fixed rate.
The absence of initial barriers is a core focus of the proposal, because in a traditional market, you're either saving for years, sometimes a decade, to build up a mortgage equity deposit, or you're handing over thousands in a rental deposit just to get the keys.
Yeah.
This model is designed to eliminate both of those hurdles entirely.
And what if your life changes? Let's say you get a job in another city or your family grows and you just want to move.
You can just go.
Right. The text indicates you have the freedom to walk away. There's no massive mortgage debt hanging over your head that you have to somehow clear or transfer. You aren't trapped by negative equity if the broader property market takes a downturn.
That specific combination of long-term stability and short-term flexibility targets a very particular demographic. The policy intent explicitly focuses on two groups: lower-income households and what the document calls the forgotten middle.
The forgotten middle.
Yeah. If we connect this to the bigger picture, the forgotten middle represents a massive swath of the working population.
So let's visualize that forgotten middle for a second.
Yeah.
Imagine a household with a teacher and a nurse. They have solid, stable jobs and a decent combined income. But because of that income, they earn way too much to ever qualify for traditional state social housing.
Exactly.
Yeah.
Yet at the same time, when they go to a commercial bank, the stress tests, the required deposit, and the inflated open market property prices mean they are entirely priced out of actually buying a home.
They're caught in the gap.
They are. And as a result, they are trapped in the private rental sector, dealing with expensive, unpredictable lease cycles. This perpetual bond model is proposed as an escape hatch from that cycle, aiming to provide long-term cost certainty without the massive upfront capital normally required for ownership.
Which naturally leads to the big question of financial viability. I mean, how can a state offer brand new homes at a fixed, never-increasing rate of around 1,100 euros without absorbing massive losses or going bankrupt?
It sounds impossible at first glance.
We really need to look at the financial engine running beneath the surface.
What's fascinating here is the specific mechanism the document outlines to fund this. It relies on two main entities. First, a dedicated state-owned state housing company, and second, the Ireland Strategic Investment Fund, or ISIF.
Okay, the ISIF?
Yes. ISIF is a sovereign development fund, meaning it manages state wealth and is mandated to provide patient, long-term capital for projects that actually benefit the national economy.
And the mechanism connecting them is the perpetual bond.
That's the engine.
The state housing company issues this bond, and ISIF buys it entirely. Let's pause and make sure we really grasp the math here, because the mechanics of this are quite specific and they change everything about how the housing is paid for.
They really do.
Under a normal bank mortgage, your monthly payment covers the interest plus a portion of the principal amount you borrowed.
But under a perpetual bond structure, the principal is never repaid.
Never.
Never. The financial instrument requires only perpetual coupon payments. In simple terms, the state housing company is only ever paying the interest-like yield forever. By removing the need to pay down the principal debt, the monthly cost drops dramatically. This aligns long-dated housing needs with long-dated capital.
Let's look at the baseline numbers the document provides to see how that actually plays out. The illustrative unit cost in the text is 400,000 euros to acquire a home.
And the authors note that a place like Dublin might be slightly higher, but 400,000 is the baseline used for both houses and apartments in their modeling.
Right. So if the state wants to fund a massive program, let's say 5,000 units a year, that requires 2 billion euros in annual capital from ISIF.
To service that 2 billion, the target bond coupon, that perpetual interest rate paid to ISIF, is set at a fixed 2.75%. And to ensure stability, the text specifically notes there are no calls and no step-ups.
We should probably define those terms for anyone who doesn't spend their days reading sovereign bond term sheets.
Of course. In finance, a call provision means the lender has the right to suddenly demand their initial money back early.
Okay.
A step-up means the interest rate automatically jumps up to a higher percentage after a certain number of years. By explicitly banning both calls and step-ups, the system is mathematically locked in. The state company knows it will only ever pay 2.75%, and ISIF knows it cannot suddenly demand the $2 billion back.
On top of that locked 2.75%, the state housing company adds a 0.5% operating margin to cover its own costs.
Exactly.
So 2.75% for the fund plus 0.5% for operations gives us a total required yield of 3.25%.
And when you apply that 3.25% yield to the 2 billion euro capital requirement, you are looking at 65 million euros.
Which is the total annual rent income the state housing company needs to collect to sustain the whole system.
Yes. And here's where the 1,100 euro figure comes from. If you divide that required 65 million across the 5,000 units, it comes out to exactly 13,000 euros per unit per year.
Divide that by 12 months, and you get 1,083 euros per month. That is the baseline rent.
It's remarkably precise.
When you consider the volatility of standard interest rates that we have all seen in the commercial market recently, asking you to consider how a locked 3.25% yield divorces the cost of living from the chaos of the open market is a huge shift in perspective.
It creates a completely closed ecosystem. But the document acknowledges a crucial reality. While 1,083 euros a month is highly competitive compared to commercial rents, a flat rate just does not work for everyone.
Right, because not everyone has the same income.
Exactly. To maintain the financial sustainability of that 65 million target while remaining inclusive, the model incorporates an income-tiered allocation system.
The overarching rule in the proposal is that rent should be less than or equal to 30% of a household's net income. How does the model adjust the math to make sure different income brackets hit that target fairly?
The designers propose a specific 50-25-25 split for the housing units. Half of the units, 50%, are allocated to what they call the average payer.
Okay.
This tier pays that baseline 1,083 euros a month. To comfortably afford that under the 30% rule, their implied minimum gross income would need to be around 53,600 a year.
That covers our hypothetical teacher and nurse from earlier. What about the other half of the units?
25% of the units are allocated to a higher payer tier. They pay a 25% premium on the baseline, which comes to 1,354 euros a month. Their implied minimum gross income is around 74,500.
And the remaining units?
The remaining 25% of units go to a lower payer tier. They receive a 25% discount, paying just 813 euros a month, with an implied gross income of approximately 38,500.
Okay, the tiering makes sense mathematically. The premiums from the higher incomes subsidize the discounts for the lower incomes, keeping the overall average at that crucial 1,083 mark.
But human behavior isn't always perfectly mathematical.
It definitely isn't.
What is the contingency plan in the text for when a unit sits empty for 6 months because someone moves out, or a household suddenly loses a job and falls into arrears. In many private rental situations, or even some cooperative models, a shortfall often means the costs get passed on to the neighbors. Rents go up to cover the gap. Does that locked yield just collapse if people stop paying?
That is precisely what the 0.5% operating margin is designed to prevent. That 0.5% might sound small, but on a €2 billion portfolio, it generates about 10 million annually.
Wow. Okay. A portion of that funds outsourced property management, insurance, and cyclical maintenance. But crucially, any surplus from that margin builds up a central reserve over time.
So it acts as a financial shock absorber.
Exactly. The buffer absorbs the impact of voids, arrears, or unexpected major works. The text explicitly states that because of the central reserve, occupiers' costs do not need to be adjusted to cover for their neighbors' shortfalls or empty units.
It's huge.
It is. The risk is managed at the portfolio level, completely insulating the individual household from the financial struggles of the wider development.
Here's where it gets really interesting. Because paying this fixed rent doesn't just make you a standard tenant on a standard lease. The document outlines a completely new statutory tenure class created specifically for this model called the Perpetual Occupancy Right, or POR.
The PR is designed as the legal bridge between renting and owning. It would be created by primary legislation and registered directly on the property's land title, but it comes with a very specific, strict limitation.
The legal title.
Yes, the occupier does not hold the legal title to the property. The state housing company remains the permanent legal owner.
And because you don't hold the title, the proposed statute explicitly prohibits you from treating the property like a financial asset. You cannot sell it, you cannot mortgage it, and you cannot sublet it to someone else for a profit.
Right.
If you attempt to transfer the property on the open market, the text says the attempt is legally void. You are essentially buying a permanent right to live there, not an asset to trade or speculate on.
The trade-off is central to the model. In exchange for giving up the right to speculate on the property's value, you gain an immense amount of personal freedom compared to a traditional rental. You are granted exclusive possession of the property as your principal residence. The document notes this is intended to provide the autonomy and dignity to treat the space exactly like an owner-occupier would. You can paint the walls whatever color you want, change the flooring, put up wallpaper, get pets, undertake internal alterations, and even build extensions if you get standard planning permission.
You don't have to live with standard issue magnolia walls just to ensure you get your deposit back. It feels functionally identical to owning your home. And maybe the most surprising aspect of the POR detailed in the text is the succession rights.
Yes, the occupancy right is inheritable. It can be transferred within defined family and succession rules outlined in the proposed statute.
And there's a massive financial implication to that.
Yeah.
Because you aren't inheriting a highly valued €400,000 physical asset.
You're just inheriting the legal right to continue paying the fixed coupon rate.
Exactly. So you completely bypass traditional inheritance tax concerns. You are passing on a highly affordable fixed-rate housing contract to your children, providing intergenerational stability without the tax burden usually associated with inheriting real estate.
But the document is clear that with those extensive rights come very clear obligations, specifically regarding maintenance. The statute creates a definitive split in responsibilities. If you are occupying a house, you are responsible for all the maintenance, exactly as you would be under a normal mortgage.
So you fix the plumbing if it leaks, you replace the carpets when they wear out, you fix the roof.
Yes.
That makes sense for a standalone house. But what if the unit is an apartment in a large complex? You can't have an individual occupier responsible for the elevator.
For apartments, the model adjusts. The occupier maintains the interior of their specific unit, but the state owner retains responsibility for the structural integrity of the building, all shared parts like hallways and roofs, and crucial life safety systems like fire alarms in the common areas.
There is a really practical hurdle the authors anticipate here regarding major renovations. Let's say you've lived in your POR house for 15 years, and you want to put in a brand new expensive kitchen or upgrade the heating system. Normally, a homeowner might go to their bank and get a top-up loan against the equity in their house.
Right.
But under this model, you don't own the legal title, so a commercial bank won't lend to you using the house as collateral.
The text provides a solution for that exact scenario. It includes a provision where the state housing company itself may loan funds directly to occupiers for major interior works.
Oh, that's clever.
It's a closed-loop system. The state funds the renovation, adding a small additional payment to the occupier's monthly fixed cost until the renovation loan is cleared, while the core rent remains untouched. This supports the occupier's autonomy while simultaneously upgrading and protecting the state's underlying asset.
It is a meticulously designed system on paper. But drawing up a framework is entirely different from mixing concrete and handing over keys, which brings us to implementation and risk. Because anyone who follows large-scale state infrastructure projects knows they can easily get bogged down for years. How does the state plan to roll out 5,000 homes a year without massive government delays, planning disputes, and cost overruns?
That is the big question.
How do they avoid the classic builder's trap?
The builder's trap is a major concern for any state intervention. Typically, when a government tries to build housing directly, they face years of acquiring land, navigating complex planning permissions, dealing with local objections, and managing volatile supply chain costs for raw materials. By the time a project is finished, it is often years late and wildly over budget.
Right.
The proposal avoids this by entirely changing the procurement strategy.
They shift the risk back to the private sector.
Precisely. The text is very clear. The state housing company does not develop the properties directly. It does not expose itself to those long planning and construction delays. Instead, it enters into framework agreements to acquire completed units from private developers.
That is a fascinating workaround. They basically let the private developers take on the headaches of construction, the supply chain logistics, and the planning risks. The state simply steps in at the very end with a massive checkbook to buy the finished units at scale, ready for immediate occupancy.
And the document outlines a very specific, phased roadmap for how they intend to scale this up safely. The first phase, covering months 0 to 30, involves no building or buying at all. It is strictly about drafting and governance.
Setting a foundation.
Yes. They draft the enabling bill for the Perpetual Occupancy Rights Act, establish the company board, and negotiate the complex financial term sheets and covenants with ISIF.
And then they move to a testing phase in months 6 to 18. The pilot program.
In the pilot phase, they aim to acquire between 500 and 1,000 completed units across diversified locations. The purpose here isn't to solve the housing crisis overnight, but to test the plumbing of the system in the real world.
That makes sense.
They need to verify the eligibility checks, test the letting process, and ensure the rent collection systems function smoothly before committing billions.
Assuming the pilot is successful, months 18 to 60 is the massive scale-up, ramping up to that target of acquiring 5,000 units per year. But operating a portfolio of that magnitude carries immense operational risk. The proposal relies on a core principle of requiring no new exchequer capital once it is initially seeded. The state cannot be on the hook for constant bailouts.
To protect the state from financial exposure, they rely on several robust operational backstops. First, the day-to-day property operations, dealing with tenants, collecting rent, managing minor maintenance, aren't handled by a centralized bureaucracy. They are outsourced to independent professional management agencies on multi-year, performance-based contracts.
The text mentions KPI-linked fees.
Correct. Their management fees are directly linked to key performance indicators. This means the outsourced agencies are financially incentivized to manage arrears aggressively and keep vacancy rates as close to 0 as possible. If they fail, they lose a portion of their fee.
But what if there is a macroeconomic shock? Let's say a severe recession hits, unemployment spikes, and suddenly a significant percentage of the occupiers genuinely cannot pay their fixed rent, regardless of how well the management agency performs. Does the state housing company default on its bond payments to the sovereign wealth fund?
That scenario is mitigated by what the document calls a DSRA, a debt service reserve account. This account is targeted to hold 12 months' worth of coupon payments at a steady state. It is slowly funded over time from those 0.5% operating surpluses we discussed earlier.
So, if arrears spike dramatically, the DSRA ensures ISIF still receives its full coupon payment for an entire year.
It buys time.
It gives the system a 12-month runway to stabilize, work out payment plans, or transition occupiers, without ever risking a default that could impact the state's broader credit rating. The text does mention a state contingent guarantee, but it is structured strictly as a contingent liability, meant only as an absolute last resort if the DSRA is exhausted.
Exactly. The multiple layers of defense protect the core asset.
So, what does this all mean? When we pull back and look at the entirety of these mechanics, the zero principal perpetual bonds, the income-tiered rents, the rigid legal structure of the PORs, the outsourced management, and the massive reserve accounts, what is the ultimate takeaway? At its core, this document outlines a highly engineered system that attempts to fundamentally restore predictability, autonomy, and dignity to the renter. It proposes a viable mathematical path to bypass the traditional mortgage trap, to strip away the paralyzing need for massive upfront deposits, and to guarantee that the roof over your head won't suddenly become unaffordable because of inflation or market speculation.
And beyond the individual benefits, it introduces a profound macroeconomic shift detailed in the text's long-term vision section. They call it the rent-to-coupon loop.
The rent-to-coupon loop.
In a standard, highly commercialized housing market, a significant portion of the rent paid by citizens often leaks entirely out of the domestic economy. It flows upward to offshore institutional investors, international equity firms, or overseas landlords.
The wealth literally leaves the country.
But under this perpetual bond model, the household housing payments, the rent, go to the state housing company. The company then uses those exact funds to pay the coupon directly back to ISIF, which is the nation's own sovereign development fund. The loop recycles household payments directly back into the domestic economy. The capital is retained to support national economic activity rather than leaking offshore.
That is a staggering shift in how a country manages its wealth. It transforms housing from an extractive asset class into a closed-loop national utility. So as we wrap up this deep dive into the mechanics of the perpetual bond model, we want to leave you with something expansive to ponder on your own.
This raises an important question. The document focuses exclusively on using this mechanism to solve the housing crisis. But if a nation successfully stops the leakage of housing wealth to offshore entities and recycles it entirely within its own borders, how might that fundamentally alter the economic resilience and wealth distribution of the entire country over the next century? And what is stopping them from applying this exact same model to other critical infrastructure, like green energy grids or massive national healthcare facilities?
It's a fascinating concept, and the implications ripple far beyond just the property market. Thank you for joining us as we explore this comprehensive policy proposal. Keep learning, keep questioning, and we will catch you on the next deep dive.